Welcome to another edition of Zacks Rank Buy. I am Brian Bolin, and I am the aggressive growth stock strategist here at Zacks Investment Research. And I've got two more stocks for your aggressive growth radar screen. I'm going to go a little bit different today. I'm going to do a company that has just reported earnings, and then I'm going to review a company that is going to report earnings tomorrow. So let's just jump right into it, shall we? First one is Palo Alto Networks. It's PANW. It's a Zacks rank number 2. That's a buy. C for growth, D for value. Now, I don't really like to see a C for growth. I like to see good growth, but I think there is good growth here. Quick look at the chart here. June, we're coming up. July, we're coming back down. August, and we're taking off. And now we're at 370. So we're way up here on the chart. Good to know. So this is a very large software security play at $111 billion. You can see the other day was, 3 months from today will be the next earnings report or thereabouts. And we can see already 55 times earnings. It's a big number. All right. And it's up 8% or $30 today. If I just had one share, I would have made $30. All right. How have they been doing on reporting the number? Well, they've been beating. And in absolute terms, kind of that up, down, up. A little bit of seasonality in there, but ever increasing earnings. Good to see. How about our earnings estimates? Are they moving along? Well, we're not going to see anything here for a couple days because they just reported yesterday, and it takes the analysts a little bit to get their reports in. There's some stragglers. A lot of them have them in the next morning, but some stragglers are out there, and then our Zacks system needs to go through it and figure it out. But as we can see, there's really no movement over the last 30 days for almost any of these numbers. It's just a penny higher on next year. But we should expect to see those earnings numbers move up, at least because we had a beat and things are going well. So we've got 13% top line growth this year, accelerating to 16% next year. All right, let's go ahead and take a look at the valuation. We hinted already it's 55 times, and for 15% top line growth, that's a little bit expensive. Price to book is 20, we'll call it 25 times. Asset slim model. Since there's not a lot of assets behind the software, it's just replicated for everybody as soon as they get it. There's not a lot of hard assets on the books, so this number is going to be inflated. Value people don't like to see that. The growth people don't mind it. But we like to see growth people care to see a good price to sales multiple that's moving higher. All right. So the company has just reported earnings. So we only look at the last two margins and we can see they've moved up sharply. We like to see that. That's good news. All right. Let's take a look at the chart. And this chart is nothing but a thing of beauty, right? I mean, keeps on grinding higher, ever more valuable. The lines in between the numbers give us the indication of good earnings growth, and that's some big earnings growth that we're going to see there between 25 and 26. All right, the stock is up quite a bit today, 30 points, give or take a little bit. I would look to be adding this on any pullback. So that would be Palo Alto. It's a big cap. It's a big name. Not what we're used to seeing here on the rank buy, because it only has a C for growth, but something that's good to keep on your radar screen, strong and steady. All right, this next one is Dycom Industries. It's DY is the ticker. It's a Zacks rank number 2. That's a buy. Again, a C for growth and a C for value, kind of in the middle. It's a heavy construction play, but mostly focused in the telecom sector. This one is only about 5% of the last company, so it's $5.6 billion. Oh, and they are reporting before the market opens tomorrow. So I hope you caught this video before the print tomorrow morning. If we take a look at the chart, we see a beat. The stock performed nicely, hung out in a trading range, and is running up into what everyone wants to do. Everyone wants to beat. I want to see a beat. I want to see everyone doing better. Improvement, constant improvement. Small, but constant improvement. That's a great way to be. All right, they're beating the number. They're beating it handily. Oops, there's a miss, and we're back to beating it. and they're beating it pretty big, and that miss isn't quite as big, so that like $1.05 versus 12 cents, 73 cents beat. So overall, I'm going to say it's a good earnings history. Let's get rid of those lines. And now let's talk about this movement again. 90 days ago was the last earnings report. And then you can see the estimate moved up and tickled higher just a little bit more, and then is held there. Kind of same incident idea here. And then this number has kicked up, and then next year has kicked up. So we're seeing those numbers move, but basically just around earnings. That's when the old Zacks rank helps you the most. All right. Are we growing? We're growing at double digits this year, 11%, and slowing down a little bit. It's still posting 8.6% growth next year, getting up to $5 billion in sales. That tells me right away we're right at that 1 times price to sales, just about. So 1.3. 5 times book. Much more palatable than 25 times book, and 24 times earnings with your 10% top line growth. So what's going on with margins? They're trickling higher. I think this is a business that everyone understands. Is there a moat there? Maybe a little bit of a moat. You got to have a lot of product to sell into this sort of service. If you're going to be selling to T-Mobile, to AT&T, and those big names, you're going to be building their towers. You're going to be building their poles. Whatever else it is that they build, got to have a lot of money behind you to do that. So, but is it that valuable? That's the question. Slim margins, low mid revenue growth. Okay, so we've kicked up higher this year. Everyone expecting growth, big growth that year, but no real impact on the stock, and that was 22. So in this time frame, that was the tech wreck of 22. Remember, we're all going to die. We get a reprieve, tech wreck, and then we're going to move higher into the election. So decent movements, it's a little tight, but it is what it is. It's a $193 stock. I think that's going to keep a lot of people away from both of these things. But I want to remind you that when you are doing your investing, you're looking not at the price of the stock, you're looking at the value of it. You shouldn't be worried about triple-digit price tags. You should be worried about the growth and what the stock is going to do for you, because at the end of the day, it is a percentage gain. And that's how I want you to think about these stocks. All right, that's it for me. Be sure to join me next week when I take a look at 2 more stocks for your aggressive growth radar screen. Until then, why don't you go to Zacks.com/promo, check out all of our latest promotions.